Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Cam Currie from Currie Metal and Mining Group, Senior Investment Advisor over at Canaccord Genuity. With Cam, I want to talk about the environment for investors looking at metal stocks. We're not going to talk so much about the metals price. We all know that gold's at all-time highs. Silver's been doing well. Copper's above $4. But the stocks broadly, especially precious metal stocks, continue to lag these moves. So Cam, first and foremost, we hear so much about if we want major, large investors, generalist investors to come into the sector, we need to look to the major gold producers and see volume uptick, see price appreciation. But the question being, we haven't seen much good news, let's say, or exciting news out of these majors. That corresponds to kind of boring share price movement. But we have seen better action in some of the mid tiers. Will investors, in your eyes, even bother peeling back that onion and looking past the majors if they're not performing very well?
No, Corey, that's a really good question because one of the problems we've had in the sector is, I guess, for lack of better words, poor performance from the big bellwethers, the Newmonts and Barricks. And a lot of people don't know this, but the Newmont's the only S&P 500 listed gold company. And so index-wise, that's the one everyone looks at. And with its lower production, increasing costs, its performance has been mediocre at best. They even cut their dividend just recently, and they're selling off a couple assets just to bring down their debt after their acquisition of Newcrest. So that's one of the issues. I mean, if you look at, on the other side of things, the tech land, you look at the percentage change of growth in some of these new tech sectors that are in flavor right now. When you're seeing 155 or 250% increase in revenues projections, news is very positive. We're seeing some disappointments, and that's adding to the malice towards the sector. But one of the big things is our sector is so small, and most people don't realize the market cap of all global gold equities is less than Home Depot. So it's a very, very small universe. So we still have redemptions in gold ETFs in the United States. Therefore, we still have lackluster interest in the equities. So that's one of the biggest problems. But going back to your question about the mid-tiers, the Eldorados, the Alamoses, the Lundin Golds, they've got greater weighting of indexing from some of these U.S. index funds. And so they're performing quite well, and they've been executing as well. And so it's a lot easier to execute when you're a 500 to a million ounce producer opposed to a 4, 5, 6 million ounce producer too.
Okay, just along that line of thinking, there's a lot of the mid-tiers inside of GDX and GDXJ, and I wonder what the impact of passive investing is on people that used to stock select and pick individual mining companies. Do you think the trend, not just in the precious metal sector, but really across most investment classes into ETFs and into passive investing, is that taking a toll on the sector?
Well, not just on the sector, but that's the new theme of investing, period. I guess about 3 weeks ago, it was published in the States that passive funds, ETFs, have now surpassed managed funds. I think it's over $17 trillion. And so what you have now is people just buying passively. And that's why you're seeing these moves in the NVIDIAs, the AI stocks, and the cybersecurity stocks. Because, if you go back in time, for example, I guess a classic example would be back in the cannabis days when all the cannabis stocks went nuts. It was all the passive ETFs the U.S. investors invested in that got sprayed into the underlying companies. And that's what exponentialized the valuations. I've mentioned this numerous times that Tilray went to $260 a share because of ETFs. Now it's $2 a share. And so we have these moves, and passive investing is driving everything. So one of the things that we have to see here, we've seen some price action in gold. Now the narrative has to take place, which we're now just starting to get. Last week, there was a feature on CNBC, or 2 weeks ago, on gold, very positive, opposed to a lot of times it's negative. So you get the price action creates a narrative, and the narrative will create the ETF flows. And that's where I think we are. I think we're very close to getting some ETF flows coming into the equities because the managed funds, the gold funds, are still getting redemptions right now.
Exactly. That's a key point, though. Even with gold's breakout, silver's better performance, we continue to hear about ETF outflows, but we have at least seen a slight uptick in volume. So what data are you watching for? How are you going to view if we are actually seeing a true trend change with investors coming into the sector, or if this is kind of another bounce that we've seen throughout the years for this sector that just doesn't take us that far?
Well, looking at gold price and gold ETF flows in the U.S. is one of the key things. Gold ETF holdings in the States have gone from 3,600 to 25 and change. So they've, we've had a money flow outflow of ETFs. I'm looking for that reversal as one. The other thing too, I think, is that we've seen this exponential move in some of these narrative stocks in the United States. And I think once that rate of change starts normalizing, money will look elsewhere. And gold's at 2162 right now. It's near its all-time high. And a number of these companies are doing extremely well in this environment. And so we will see some money flows. In the last couple of weeks, we've seen much greater volumes in the Newmonts. We've seen much better volumes in Barracks and the Kinrosses. And so it may be an indication that we're starting to get some positioning. One of the interviews that I was recently watching was was the CEO from Agnico at the BMO conference. He was talking about some of the big generalist funds and investing in Agnico. And they're looking at the markets right now because they're getting nervous about valuations in the States, and they're getting a little bit more nervous about the economic outlook and obviously the geopolitical environment. So they're playing that market still, but they got an eye on the gold stocks, and they are getting more and more interested. And the data coming from these generalist funds was in the last 15 major corrections since the 20s. Of the 15, gold went up on average 40%, and after when those corrections taken place. So if they're thinking correction in U.S. equities, then you should have a position in gold and gold equities. And I think they're starting to pay attention to that. And that narrative will create money flows into the passive ETFs, and that will have an impact on price. And that's what we need to happen here.
Cam, when you look at some of the companies in the gold and silver space and really across the resource sector that have resources defined, they either have a resource estimate or maybe they even have some economic studies in place. I don't remember ever seeing such a big divorce between where they're being valued in ground, the ounces in the ground or the pounds in the ground, versus where the metals prices are trading. What is your take on that disconnect?
A number of reasons. One of the main reasons, there's been a number of articles recently in National Post, Pierre Lassonde and Frank Juster have been pointing this out, is since 2010, the money flows or money outflows out of the resource funds in North America and in Europe is absolutely incredible. I mean, it used to be like $12.5 billion in resource funds in Canada. Now it's down to $2 billion. And so you have an absence of investors in this space, and a lot of them have left and gone on to other sectors. We all saw the movement of the speculator moving into cannabis and crypto and all those things in the past, and they just haven't come back yet. And so that is a major problem. Like I said, we're still getting redemptions in the gold funds. I had a fund out of the States I was talking to last week, and honestly, their body language and their tone was nothing short of being depressing because they've had a tough time. And so going back to the juniors and the developers trying to raise capital for these companies right now, I mean, it's extremely difficult because there's zero interest. And just on another note, a lot of investment advisors now are passive investors. They just plug and play ETFs. So stock picking and speculating in the resource sector is a very small universe of people now. And so that's one of the other problems too, is so when you have so few people looking at these things, it's tough to raise money for the developers.
Yeah, it's just smaller sector all around. Investors and company market caps much smaller. But on to that financing environment, do you see that changing? Are we going to get a flow of capital coming in that cashes up a lot of these companies? Or for the investment standpoint, do we need to be focused on those companies right now that have money or at least have had access to capital over these last 3 years?
Well, just a reminder, we are in a cyclical business, and metals are required to run, technology, electricity. I mean, it's everything about what we create out of the ground is important to the new age technologies. And so the answer to the question is, of course, money will come back. Question is when. I mean, I think what's so frustrating amongst a lot of resource or precious metals investors right now is their goals at 2165, near all-time highs. There's no other commodity like that, and in terms of pricing. And yet our stocks have underperformed. So I think a lot of people are they're exhausted and they're going, just get me out of these things. They aren't performing. So money will come back in, and it's typical. I mean, money chases momentum. And if you go back in time about 2 years ago, if you look at uranium was dead. Now look at it. Cameco went from $12 to what? $65 as a high. Next gen as well. That was $1.52. Now it's at $10. So money will come in once they see price action. And that is such an important part of it because price action will create narrative, and narrative will create money flows because passive funds are the driving force. I would surmise that we'll see money flows coming in from ETFs first, and then later on we'll get some of these managed resource funds getting money flows in because that's just the way the flow seems to work these days.
Well, Cam, another phenomenon that sometimes drives interest into the sector is mergers and acquisitions, and we haven't seen that much M&A. The M&A we have seen is the big boys acquiring each other or merging with each other. We haven't seen a lot of those traditional go down the food chain and pick off the single asset producers or the development projects. We've seen a few. Do you think that because of the dynamics where the metals prices are doing so well, but the actual companies' valuations are so small, that we'll see an uptick in M&A?
We will at some point. Like I said, everything's cyclical, and eventually there'll be a wake up in the boardrooms of the companies that have no growth or means for placing production, and they're going to be looking 3 years out, 4 years out, and go, okay, what are we doing now that we see actually confidence that we're in this price range for precious metals and we're going higher? Then we have to start making some decisions, and we haven't seen any of that. I mean, sure, you saw Newmont buying Newcrest, and there's been other acquisitions, but I'm a big believer in M&A if it makes sense. Just recently, Caliber bought Marathon, and that was a marriage of two assets that, in my view, basically makes 1 + 1 = 5. And they just got put into the GDX last Friday, which was 43 million shares of buy side coming into it. And here's a new co that's been created, a 300,000 ounce producer. Now Valentine of Marathon's asset is under construction, and that will take it to 500,000 ounce production. Puts into the realms of the mid tiers like the Lundin Golds, the Alamos Eldorados, and the re-rate alone on that, in our view, should send the stock upwards of $3 a share, now trading at $1.86. So in a case like that, that makes sense, and we're very, very big in the sponsorship of that entity. But M&A for the sake of M&A, just to attract investor interest, it has to make sense, and that's one of the problems. A lot of M&A done in the past didn't make sense, and the industry is still being penalized for that.
Hey, in all fairness, at the end of that last bull market, let's say 2011, people were saying, look, these companies need to stop doing M&A. The majors need to clean up their balance sheets, control their production. They have, but investors sure haven't reacted to that. So from more of a portfolio management standpoint, do you think it's better to focus simply on companies that are in production making money, those that are being close to being built, or maybe even early stage developers that still have to get a project over the finish line to actually start producing?
Well, again, depends on your risk profile. For some investors, I mean, I have seniors, mid-tiers, developers. I'm not going down to the grassroots exploration arena right now because if this market doesn't get money inflows in the next 12 months, some of these companies are going to have a real difficult time staying alive. And so why would I go down to that level when I can buy some other companies trading, at 7 times PE multiple debt-free? I mean, there's some great companies out here that are just dirt cheap. And that's one of the advantages of being in my place, is that the passive ETFs spring into the underlying components of those indexes. I'm looking at companies and buying companies up that are not in these indexes, that there's no money flows, and if anything, there's redemptions that have been sold off because they're doing so well. And that gives us an opportunity to buy great companies at a discount because there's no money in the space, and we have capital to deploy.
Well, Cam, another thing investors look at, I'd love to get your thoughts on it, is the jurisdictional risk, or the ability to parse through the data and find out some of these companies are already overly discounted because of their jurisdiction risk. How do you look at jurisdiction? Are there areas that you like to invest in or areas that you avoid?
Well, there's some companies I've been involved with in the past and I just don't go back to. But risk is a funny word to use in the mining industry because I would argue that, say, in Canada, for example, trying to build a project on time, on budget is a high-risk proposition. Trying to get permits in Nevada to even build a project is a high risk because it can take you a number of years. In West Africa, for example, you have risks there with the geopolitical risk and the narrative risk of what's going on in countries like Niger, which is impacting the perception of the whole arena. And yet you can get a project permitted and built in a very short period of time, on budget. So both jurisdictions, be it North America or West Africa, carry different types of risks. You just have to understand what those risks are. And if it creates an opportunity for greater unlocking of value, if some of that narrative risk or profile risk of permitting can be worked through. A lot of times you have to make sure you're buying into companies at this proper level of the time cycle. I've got 5 companies I really, really like, but I'll visit them about a year and a half from now because they're in that permitting stage and there's just no news. Country risk. I mean, look what happened down in Peru and Chile. I mean, we were doing great. Look what happened in Panama with Kobe Panama. I mean, you just never know what's going to happen. So that's why you need a diversified portfolio and someone who knows to assess the risk of these different jurisdictions.
Yeah, so true, Cam. It's hard to predict jurisdictional risks sometimes, especially in countries that even seem kind of safe at one point. But there are a lot of countries out there that are viewed as always on the verge of maybe taking projects away. One more comment, though. It seems like we're talking a lot about precious metals here, and quite frankly, the lack of interest in precious metal stocks. You brought up uranium, how that drew in some investors. Can these other resource sectors, can they help out the precious metals sector by performing better and bringing more investors into the resources broadly?
Well, we just saw a move in the copper stocks in the last week because of a number of smelter shutdowns in China. And so there was some very strong price action in the stocks. And so I think one of the things about the whole resource sector as a whole is if there's some great profits made in one aspect of one commodity, then those commodity investors may look at other commodity stocks. And so creating wealth can create money flows to go into other companies or other sectors for that matter. So yes, it does help each other. But, I think that copper investors are different investors than gold investors though too, right?
Yeah, that's very true. But hey, any sort of gains in the resource sector can help at least some money maybe stick around. Unfortunately, they've just been few and far between. Outside of uranium stocks did really well. Lithium stocks did really well a couple years ago. Those have given back some of their gains, but there does seem to be a bit more life in that uranium sector. Some of that money definitely stuck around. It does just seem to be a still tough environment for precious metals stocks, even the copper stocks, which have gotten a little bit of a bounce recently. Just not as much financing out there. Hopefully that all changes for these companies. Cam, thank you very much for your insights. I'll post a link to the Currie Metals and Mining website so you all can keep up to date with Cam and what his group is doing within the resource sector. Cam, have a great rest of your week. We'll chat again soon.
Thank you, Corey. Take care.